And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal. The full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. This morning, of course, it is tariff turmoil day, to say the least, as we start to deal with, what's happening, with the Trump tariffs. Now, we've heard a lot about this coming now for the last several months. We've talked about it. We've been dealing with it. And one of the issues that has been weighing on markets, as we've talked about before, is simply the inability to kind of calculate what forward earnings are going to be because the tariffs were so much in flux, right? We did, it's kind of off the cuff. I'm going to put 25% here or 10% there or whatever it was, but there was no real kind of uniformity to the tariffs. And unfortunately, we don't really have any uniformity, but we'll talk some more about that. But we do have a worst case scenario, and that's the thing the markets are going to deal with today. Futures are pointing sharply down. This morning's before the bell is going to be a bit long. That's the reason I'm. If you're watching our YouTube stream, it's a little bit of a different open this morning because we're going to go through quite a few charts here. Just kind of an update on where markets are, where things are kind of trading right now, as markets are coming to grips with a much worse than expected scenario. Markets were going into this announcement yesterday thinking that there was going to be a 10% reciprocal tariff across the board. That turned out not to be the case. It's actually much worse than even kind of some of the predictions. And this is one thing that we talked about on the show for the last couple of days, is that, and we talked about this yesterday specifically on the show, is that if these announcements came out, and this is why it was, and I said yesterday, this is why it was hard to hedge going into this, is because if the announcement was less than expected, right, the markets were going to be up 2% today. And if they were worse than expected, we'd be down 2% today. We're going to be down 3% this morning at the open. So we'll see how this goes. But the bad news is the tariffs are much worse than expected, right? That's the bad news. So I just want to kind of start with this. So again, this is what you need to know before the bell this morning. It's going to be a little bit long, so just bear with me for a minute. First of all, as we had talked about, that this increases dramatically the U.S. tariff rate. The increase in the tariff rate under these new parameters. So, for instance, these tariffs are stacked. Like, for instance, in the case of China, he announced a 30% increase on China in terms of the tariffs, but you have to stack that with the other 20% that he had already put on China. So that's a stacked tariff. So the actual tariff on China is 54% altogether. But this leads to the highest, and you can break this chart, Brent. This leads up to the highest tariff rate we've had in 125 years. So it's been a very sharp increase. Now that's going to have to be dealt with by both U.S. manufacturers as well as potentially consumers. The question, as we've talked about before, is whether or not the tariffs can be passed on to the consumer. But this does increase costs. So this is going to drastically change forward earnings estimates for companies. And this is the one thing that we've talked about quite a bit, is that forward earnings estimates have been very elevated and that those were going to have to come down. Well, this will do that. And so when we start talking about forward earnings estimates, which is all that matters for markets, again, as we've talked about before, you can put all the narratives up that you want, but at the end of the day, what is it that markets are looking at? They price on what future expectations are going to be. Goldman Sachs came out with a range of estimates. And so when you kind of look at this table, you can kind of start running the gamut. If earnings decline, and currently right now estimates are, running at, according to Goldman Sachs, at 269. According to S&P, they're up around 270 at the moment, so close. And so if we start ratcheting those down on the basis of these tariffs, that's going to reduce the upside for the market. So Currently, we're running at about 22 times forward earnings. So at a reduction to, let's just use worst case scenario, we reduce earnings down to $220 a share. That brings the markets down to about $48.50. So that's some decent outside at 2,200. But again, this is the worst case scenario for this. So there is downside to the markets. Even and historically, going back to the turn of the century, the market tends to trade between 18 and about 20 times earnings. So you can kind of run the gamut somewhere between 3,950 to 5,400 based on those estimates. Well, what that suggests is, and something that we've talked about several times this year so far, is that doesn't leave a lot of upside to the markets this year. Lots of volatility, lots of trading ranges potentially, but not a lot of upside. And as we've said earlier, we may have seen the upside for this year already. So this is what markets are going to have to deal with, though, is trying to figure this out. Now, there is some good news to this, which is that these are kind of the worst case scenarios in terms of the expectation of what the tariffs were going to be. So that's the bad. The bad news is very, very elevated levels of tariffs. The good news is that these were worse than expected tariffs, right? So now any relitigation of these tariffs by the Trump administration, if countries come back to the table and say, hey, we want to, we'll reduce our tariffs if you'll reduce your tariffs, and we start reducing those tariffs, that does provide some upside for the market. So the good news is from this is that the relitigation of these tariffs over the course of the next 6-8 months, as we kind of go forward, is going to potentially provide some benefit to the markets, because then those estimates will start to come up. So so again, yes, very shocking news yesterday, worse than expected, and the markets are responding to that this morning. Markets going to be down 3.5% at the open this morning. So expect a knee-jerk sell-off. I would be reticent to sell into this sell-off this morning. Typically, markets tend to react the worst and kind of on the news, and then markets kind of rethink things once markets kind of get opened and underway. So be a little bit cautious about knee-jerk reactions this morning relative to the market or making any type of big decisions. But let's look at some charts here real quick, just on the S&P. I had laid out this chart for you a couple of days ago showing these Fibonacci retracements. We're going to be testing that kind of that 36.3% retracements. That's that next level of support. We're going to take out the recent lows this morning. We'll see how the market responds at this point, and where we close will be very, very important today. But we are going to be testing support that goes back to last year, and the market should try to find some support at this level. But again, there's some good news, bad news. First of all, the bad news is that we are taking out the recent levels of support. The good news, if you want to kind of put it that way, is that the markets are already oversold. The good news here is that we're not starting from overbought conditions. This news just hit, and markets are having to rapidly reprice everything from a very overbought condition. We've already been in a correction now for the last month. We've already worked through a lot of this repricing in the markets already. And so we're getting to levels where even with this decline today, we may find buyers coming into the market. So that's why I'm saying be a little bit cautious about knee-jerk reactions here. Bonds are going to perform well today on this news. That'll help hedge portfolios as well, limit some of the downside. But again, companies, and particularly that deal a lot with China, are going to be hit today. Apple, Microsoft, NVIDIA, Google, the Mag 7 are going to be down. 42% of their revenues come from overseas. They're going to be hit. So the S&P itself is going to be hit by this impact of foreign tariffs on markets. That's what you need to know before the bell this morning. When we come back, we'll pick up with Michael Leibowitz. We'll get into some more of this, talk about kind of some different avenues that we go forward. But again, just the word of caution here, be careful with this open. Don't overreact just yet. We need to let this kind of sort itself out for a day or two. I would suggest waiting through Friday And, then we can start making a more logical approach to managing risk as we get into next week. All right, quick break. We'll be right back with Michael Leibowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right. Obviously, lots of stuff to get into this morning. We appreciate you joining us. And, we'll kind of get through this as we go this morning. Again, futures pointing down fairly sharply. Interestingly enough, there's a lot of markets are getting hit that you wouldn't expect kind of on this news. But we'll kind of get into some of that this morning. But, of course, Michael Leibowitz today is Thursday, so he's joining me as well this morning. Good morning, Michael. How are you?
Doing wonderful, Lance.
There you go. Did you get some sleep last night?
Yep, I tried.
There you go. Yeah.
Dreams last night were not the same as most other nights.
Exactly. Well, I was at last night. My daughter's spring dance is coming up. It's her senior year, and it's their spring dance for the school, for the high school. And so I was at dance practice with her last night, and I look down at my phone, and this whole thing's blowing up on the phone while I'm at this dance practice. So, I have no idea what the dance is. I could not concentrate on that at all. So, but yeah, so a couple of things, obviously, as I was saying just a second ago, Mike, these tariffs came out kind of worse than expected. Really kind of worst case scenario. I mean, you and I had been kind of talking a little bit, just back and forth about expectations for tariffs and kind of what we thought was going to be the outcome of this. But, this really kind of drilled down into some of the worst case kind of outcomes that you could have expected. And it was kind of interesting from a couple of standpoints, because from an economic, and I wanted to share this chart with you real quick. Mike can't see this chart, so I'm going to explain it. But as you're watching the YouTube channel this morning, this is trade policy uncertainty. There is a policy uncertainty index that is published, and you can go back over time and you can kind of track the history of economic policy uncertainty. And this has led to it is the largest spike on record in policy uncertainty now surrounding in this particular case, trade policy uncertainty has now really spiked this to a large degree. Now, again, kind of good news, bad news from this. Yes, it's the largest spike on record. Historically, though, this doesn't last long. And historically, markets have recovered from these types of spikes and trade policy uncertainty. But again, this is, kind of what the markets are dealing with this morning. As we were talking about, futures are down about 3% on the markets across the board this morning. So just, Mike, what was your initial takeaway from kind of, what you heard, what you saw last night, and we'll go from there.
I think what I was really shocked at is that these were not reciprocal tariffs, that the tariffs were based on a trade deficit.
Right.
Basically half of the trade deficit. So if a country basically within 20 minutes on Twitter, whether it was AI or someone else much smarter than us, backed into the tariffs, and what was basically discovered is that it's a formula: imports minus exports divided by imports. So if a country, let's say Thailand, exports $100 million of goods to us and we export 10 to them, that's 90 is the net trade deficit. You divide the 90 by the imports, which is 10. Confusing. Bottom line is you get to a 90% trade deficit.
Right.
And then he just slashed that in half to get to a 45 tariff. Now, the problem with that is that there are nations that we should have trade deficits with, and there are nations we should have trade surpluses with. So I came into this kind of thinking that this would be about fair trade, basically offsetting tariffs, VATs, taxes, currency manipulation, all those things that don't allow for a level playing field. It turns out what the goal, at least in this first round of tariffs, and I want to stress, this is still his way of, Donald Trump's way of negotiating. He's still carrying that big stick. But it appears that the first round, or the first big announcement, is to basically get rid of the trade deficit with every country and not have a surplus or a deficit, just have equal trade. Right. Not fair trade, but equal trade.
Yeah, and I kind of want to show this chart. This was a chart from the United States Trade Representative, and this formula, which is delta TI is equal to XI minus MI over the sigma of the alpha of MI. This very convoluted formula, right? It makes it look like the government was actually doing this massive amount of work behind the scenes, taking each, kind of tariff rate on a product, and then using this formula to back into what the reciprocal tariff should be. But in reality, all they did, again, as you just pointed out quite correctly, is that all they did was took the trade deficit between us and Myanmar and said, okay, we have this, so the minimum rate of that trade deficit is going to be 10%. So if the trade deficit between us and Myanmar is 5%, the minimum was 10, right? It went to the base of 10. But again, all you're doing is taking a trade deficit, and that's, again, importantly, that wasn't really about tariffs. Yes, if you're tariffing butter 300% as an example, then you do a reciprocal tariff on butter, right? Or if you're tariffing automobiles, you do a reciprocal tariff on automobiles. But this was just a blanket tariff on every country based on their trade deficit, which is, to your point, Mike, is just exports minus imports. What was that deficit? And just saying, okay, because you import less than you export to us, we're now going to tariff you half that rate. So again, that's going to have much larger impacts potentially economically on a global basis than what we were anticipating previously. And that really increases the risk for European countries, in particular, African countries, China, et cetera, because where those tariffs are a lot larger because of those trade deficits, a lot of those countries' economic growth rates are already very weak, and that's going to really make it tough on them.
Yeah, I mean, there's just so many implications to this. You just don't even know where to start. And what makes it so hard, and I think where we got to catch our breath, is that, again, this is how Trump negotiates. He comes out swinging. And as time goes on, he kind of gets to a more rational place. And we've seen this time, we saw it in the first term. We've already seen it. He's been in office, 3 or 4 months. We've already seen it on countless occasions. He gets to a more rational stance. And, we have to assume he gets to a more rational stance with most of these tariffs, with most of these countries, because it's going to have a big negative economic effect on us and those countries. It's just for, the global economy as a whole, it's a negative. Not to say that the current system was working and it was fair. It wasn't. And it's good that something was done. But again, there's that difference between fair and equal. And while they sound very similar, they have vastly different economic effects.
Well, and again, this is the real issue that we're kind of working through right now is okay, great. This is what it is, right? So this is what it is. We now know what the tariffs are. And this is one thing that we've been talking about really for the last couple of months has been the flux in these tariffs and the unknowing. We now know what they are. We now know when they go into effect. So some of the tariffs go into effect on April the 5th, and then the rest of them go into effect on April the 9th. Why the delay? Well, that kind of gives countries some time to come back and renegotiate. So we may see in the next week, we may see some revisions to some of these tariff rates as they start this negotiation process, whatever it is. But what the markets are going to deal with today is, again, taking these tariffs at face value and saying, what does that mean for forward earnings? What does that mean for economic growth, right? So this is going to reduce both the expectations for economic growth in the U.S., recession risk, according to Polymarkets this morning, and don't take recession risk from Polymarkets as a good indicator. That's a very few amount of people placing some bets. But that recession risk has risen to about 54%. But we're going to see the risk of recession rise from these tariffs because of the net impact to economic growth and activity, supply and demand, which is what drives economic activity. That's also going to feed into earnings. So earnings estimates are going to get reduced. We'll see some very sharp earnings revisions, most likely by Wall Street analysts over the next couple of weeks as this gets factored in. I think, Mike, one of the interesting things is that we're now starting next week, we get into earnings. The major banks will come out next week, JP Morgan, Bank of America, et cetera. It's going to be very interesting to see what the CEOs of these companies are saying about these tariffs relating to what their earnings announcements are. They're expected to be better than expected on the most part because revisions have already come in a bit. But it's going to be interesting what they say about their future earnings growth based on these tariffs and how the market basically interprets that.
Yeah, I think it's all going to be about the press conference, the conference with the analysts. I don't think it really is going to, in some cases it'll matter what their earnings and revenues were and outlooks. But I think what the market's going to focus on is how do the tariffs affect that company, positive, negative, and it's unlike most times it's going to be harder to assess from a stock price perspective.
Yep. Well, when we come back, we'll talk about Trump's tariffs and the Fed and what the Fed might do now, at least what's expected from the Fed. We'll talk about that right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity? Retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
$1 million sounds like a lot of money, and a lot of people don't have $1 million. It's not that much money, considering that most people's net worth isn't $1 million in cash in the bank. That's their house and all their other stuff. That's not liquid, because if you want to extract the capital from your house, you got to sell it. That's awesome. Where are you going to live?
The Real Investment Show podcast. Same show, your schedule.
I'm going to live in a van down by the river
at realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So real quick, before we get back to our analysis this morning, just a quick funny story, just to kind of lighten the mood a bit this morning. So Mike is a big basketball guy. He likes to pay attention to basketball, knows what's going on with basketball. My wife is not a basketball fan. She never watches basketball. She doesn't understand basketball. She pays no attention to basketball at all. So she knows nothing about basketball. And in fact, if you ask her about basketball teams, she probably couldn't name 3. But her office had a March Madness pool on who would win March Madness. And they were going around the pool, the office collecting some money for the office pool, and everybody had to put in their brackets. And so they went to my wife and said, "Hey, are you going to put in your bracket for March Madness?" She goes, "Nah, I'm not doing that." She goes, "Just do it. You might win some money out of it, right?" And so she's like, "Fine." So she fills out a bracket and she put it in. Well, they came to her yesterday. She's number 1. She's number 1. She picked Duke. And so, but right now she's leading the whole pack. So, but yeah, she came home. She's so excited, right? Because she stands to win some money out of this. But I mean, this is the epitome of why, a blind squirrel finds a nut every now and then, because there is no way. I mean, I don't even know if she knows who Duke is. I think she just, picked out of the number of teams and just filled them in on the bracket. But anyway, congratulations to her, my basketball phenom that I live with. She's going to be able to buy me dinner this week. Anyway, all right, Mike. So talk a little bit about the what's happening with these tariffs. It's obviously increases recession risk by a good bit. And one of the things we're seeing this morning is a reversion in expectations of Fed rate cuts. In fact, kind of the latest is showing the Fed might, the risk or the possibility of 4 rate cuts now is no longer 0 for this year. And the big question becomes, when you have this type of, market uncertainty, which obviously weighs on consumer sentiment, which is a concern of the Fed, potentially weighs on corporations, which would impact employment. Does this increase the probability that the Fed, has to come to the table and start cutting rates sooner or maybe more aggressively than expected?
I think really what this does is, as confused as I think the Fed was yesterday, I think they're much more confused today. They're trying to balance economic growth with prices, with inflation. Mm-hmm. And from what they were, what they're digesting now is that economic growth is likely to be less than what it was yesterday. At the same time, the volatility or the potential for prices to go up or down has just increased. Mm-hmm. It's just more of an unknown, at least in the short run. In the long run, I think this is very deflationary. But in the short run, the prices of all kinds of things are going to be whipping around. So you're kind of judging, okay, well, now we know corporations are going to be sitting on their hands. They don't know what to do. Do you build a plant in the U.S. or do you wait until the tariffs are lessened? Maybe they won't be lessened. They, for instance, during Trump's first term, they moved out of China to some of the other Asian nations. And that worked well for the last 8 years. But now those countries, like Vietnam, got hit with a large tariff. So now their plant in Vietnam, for instance, is being hit with a much larger tariff than if they would have just stayed in China. So I think they're hesitant to do anything. And Lance, it's indecision. Mm-hmm. Investors, there's just indecision and not knowing how this all plays out, which is going to cripple the economy the longer it lasts. So, if I had to give Trump some advice, it would be figure this stuff out quickly and get to where that final tariff is going to be. Don't let it linger on, because the Fed, corporations, consumers, not just in this country, but around the world, are gonna sit on their hands and not spend. Yeah.
So but it's a couple interesting points though, because again, when you go back to last year, bring up this chart real quick for me. This is a chart of the VIX that I'm bringing up right now, and there's this huge spike in the VIX, and it was last August when we had the yen carry trade blow up that presented this uncertainty for the markets. Right? So, oh my gosh, and we got to unwind all this leverage. It had a huge spike in that index. And it's interesting that despite this, announcement of worse than expected tariffs, yes, the VIX is up this morning, where VIX is going to open around 26 this morning, which is below the recent peak that we saw during the sell-off back in March. When we started this kind of whole sell-off in the markets, volatility got up to about 20, 28, 29. And so even though we're having this very negative news today, it's interesting, Mike, that volatility really isn't spiking off to the moon. Yes, it's up today, but it's not, it's not even near approaching levels that we've seen previously when there's, this really kind of worse than expected news hit the market. You would have expected this morning that volatility index would have been north of 50 with this kind of news today.
Here's another one for you, Lance. Let's say you went on vacation Friday and you decide you weren't going to look at your phone or turn the TV on or anything, right? Mm-hmm. On Monday morning, we hit a low of 55.30-ish. The market sold off Monday morning, and we've pretty much rallied ever since. We're at 55.10 right now. Mm-hmm. So say you call in now and say, hey, what's the market done since I've been gone? Down 20 points. It's a massive sell-off over the last 12 hours or so. Mm-hmm. But we were rallying all week into that. And the net effect, as crazy as it sounds, is not nearly as bad as it looks. So, again, perspective is very important. And, this is where those behavioral traits will get the best of you if you let your gut make your trading decisions and not put perspective and context to everything going on and look, Lance, there's another thing that's very important. Markets aren't red and blue. Regardless, I wrote this in my article last week, that regardless of your politics, whether you love Trump or whether you hate him, you can't let that feeling of your feelings towards the president and his political party get in the way of your investments. And I think that is happening to a lot of people. Either they're uber bullish because they love Trump, or they're uber bearish because they don't like Trump. And that's another cardinal rule. And when there's political actions driving the market, I think it's very easy to let those political feelings get in the way.
Yeah, and that's true. And again, what we're seeing today too is really kind of an interesting dynamic across markets. I mean, one of the areas that you would have thought would have been up strongly today based on tariffs is gold, but gold's going to trade down about 1.5% this morning. Again, but it's coming off all-time highs, so that's irrelevant. But that's an asset that you would have thought would have been up this morning. Bonds are going to trade good this morning because of the expectations of slower growth, but that's also kind of interesting from the standpoint that tariffs are also supposed to be inflationary. So the bond market is, dealing with this kind of conundrum between potentially inflationary issues coming out of tariffs versus a much slower rate of economic growth, which is going to weigh on yields. So, so bonds are going to trade okay this morning. Gold is off. I thought it was interesting, the dollar down sharply today as well. We're approaching back to the lows that we saw previously. You can bring up this chart for me. We're approaching the lows from last September, and a very big decline in the dollar today as well. So that's obviously, we're seeing that weight of these tariffs kind of across markets, small caps and mid caps, which is also interesting. Obviously, they're going to get impacted by tariffs, but their exposure to foreign revenue is much less. When you take a look at small cap, mid caps as an example, they have very little, like 15 to 20% of their revenues actually are come from foreign sources. So they have very little exposure to that. And small caps and mid caps have already been under a tremendous amount of pressure this year. They're down much more than the rest, kind of the major markets for sure. They've given up a vast chunk of their gains. They're actually going to be down more than the S&P today. So it's interesting that small caps and mid caps are getting hit even harder than large caps, even though they have less exposure to tariffs than the large caps. You would have thought that there would have been a little bit of relief maybe in those areas of the markets, but that's not the case.
And commodities as well. If you look, crude oil's down 6%, orange juice 5%, coffee 3%, cotton 4%. I mean, they're just, unless you own cocoa or cattle, you're getting crushed in the commodity markets too. All a function of the dollar, which is down. It's down 2 points at the $2 at this point, which 2% is, in anything else, that's not a big move. But in the currency markets, that's a massive move.
It's a very, very big move. Yields are going to be close to 4% on the 10-year Treasury today as well. So, all right, when we come back from the break, we'll kind of wrap up the show, kind of get you ready for the trading day. We're not out of the woods yet by any stretch of the imagination, because on Friday, we have the employment report. We'll talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So lots of stuff, obviously, on tariffs. And again, it's interesting because the bad news is, as I said before, tariffs worse than expected. The good news is, at least now we know what we're dealing with. This doesn't end the back and forth debate by any stretch of the imagination, because this is just the first salvo. But for the markets can begin to price in kind of this worst case scenario. Most of the probabilities here now respond to, or at least equate to, potential upside from here. In other words, a reduction of tariffs, a negotiation of tariffs of some sort, or a recalibration of tariffs. That's the most likely outcome. Doesn't mean that has to be the case. This morning, there's already headlines out from different sources talking about how France is already kind of figuring out how to be even more aggressive on tariffs. So, we could get into a tit for tat kind of trade war temporarily on tariffs until there's some type of meeting at the table, so to speak, where we start to kind of hash some of this stuff out. Again, that's going to put pressure on markets. But as we're not past all of this yet, because, as I said, we have tariffs today. The markets will have to deal with that. On Friday, we're going to have the employment report. This is the employment report for March. And of course, this is what one of the things the Fed is looking at in particular in terms of, Fed rate cuts or further Fed actions, monetary assistance, whatever, is that employment report. And if we begin to see a pervasive weakness in unemployment, that's going to potentially weigh on the Fed and potentially what their outlook is and what they're going to do relative to the markets. And again, the markets have been pricing off the actions of the Fed now for the last 3 years in particular. Will the Fed cut rates? Well, they won't cut rates, or they can cut rates more, they can cut rates less. The market's been trading off every news, every economic data point that the Fed looks at, whether it's CPI, PPI, or unemployment, about what the Fed's going to do next. So we had that on Friday. So the point is we're not past the volatility from today, because on Friday, we'll have to deal with the unemployment report. And the question now becomes is, if it's a weak unemployment report, does the market look at that as good news because, well, now the Fed can cut rates? or is it bad news because it shows the economy slowing down? Mike, what do you think?
Yeah, the economic data is going to be tough. First of all, the economic data is from a month and a half ago, so it's not up to date. But I think the Fed would love to cut rates. I think they really see a risk of the economy becoming much slower. Tariffs are only making that worse, but the stimulus is quickly leaving the system as well. So you have a kind of a confluence of events that should lead to a slower economy. And now you potentially have events that are pushing it to be even more slow. So I think on the margin, the Fed would love to lower rates, but they have the inflation bugaboo. Now the weird thing with tariffs is even if prices do go up, it's nothing the Fed can do about it. Right? Prices aren't going up. It's not a supply demand. It's kind of an artificial tariff, a tax that's being put on prices. So the Fed can't do much about that, but they can do a lot for the economy. So, I'm sure the discussions within the Fed building when they have their meeting are going to be pretty lively. There's going to be people on both camps. And likewise, I think on Wall Street, the discussion around economic data will be very interesting. We're going to see the employment number. What does it mean if there were only 20,000 new jobs? That would be a very low number. That was from 3-4 weeks ago when they did the survey. Does that matter? And maybe it matters a lot to the market, and the market will go up because they think the Feds now can cut rates. Or like you said, Lance, maybe the market will drop because it confirms in some people's minds that we're going into a recession. But again, we're not going to see good economic data. Things aren't even happening yet, right? Today's the first day. So any economic activity resulting from the tariffs hasn't even started yet. And then to see that data is 6 weeks away, 2 months away. Mm-hmm. So we're going to be in an economic limbo, kind of period. That's going to be the narratives. I think narratives are what's going to drive markets up and down. And it's narratives around the economy, narratives around corporate profits and how are they going to react. And the biggest narrative is around tariffs. And like you said, Lance, will countries retaliate and will it escalate, or will they kind of come to an agreement and will they come down? And, the problem with that is, like you said, France may retaliate and China may come the other way. And so then you're dealing with good news, bad news. And I think it's just going to be a very rocky time for the market. Rocky doesn't mean down. It doesn't mean up. It just means volatile, where we could see swings of 50 to 100 points in the S&P 500 based on headlines. And just as importantly as the headlines are the narrative or Wall Street and the media's take on the headline and what they think it means.
Right. And again, this is going to be the challenge today. This market's going to open sharply lower this morning. We'll be down 3.5-4% at the open on the S&P. S&P is right now down 194 points at the open, so certainly going to be an impact when markets open. Dow's down 1,200 points. So we're definitely going to see that impact this morning. But again, what we need to see today is the market open down and stay down all day, or do we start to see some buying coming into the market this afternoon? Buy institutions starting to kind of work through this process, starting to look to see is this a tradable bottom, or is this something that's going to lead to a bigger decline? Now, one of the consequences of this move today in the markets, it's going to trigger our weekly sell signals most likely. We'll know that on Friday when we get through the end of the week, but we're getting very close to triggering those weekly buy signals, which suggest that markets may be struggling here for a while. Now, that doesn't mean markets just go straight down, but kind of what I've been laying out over the last week or so, and Tuesday's article is kind of laying out this 2022 roadmap where the Fed was hiking rates. We had the Russia-Ukraine event going on. There was certainly a lot of concerns about recession risk at that in the markets back then. But even though the markets declined, there were some fairly substantial rallies during that process that gave investors an opportunity to rebalance risk and take advantage of those rallies to reduce exposure, those type of things. That may very well be the environment that we're getting into over the next several months, and something that we'll just have to navigate very carefully. And one of the triggers for that is those weekly crossovers. And again, that's something that may happen this week, given this dynamic, depending on how the market ends today. If the market ends up positive today, it's going to, negate that statement. But, if markets open down and stay down today for the most of the day, we're going to get very close to triggering those signals.
The other thing to kind of keep an eye on is that I think Trump may feel more emboldened to talk about tax cuts. He just, basically put out all these tariffs. It's going to raise money. And he's talked about this before, that tariffs can replace income tax, essentially, and corporate taxes. So, the market may look upon that highly, right? If he comes out and says, for every dollar we're going to take in tariffs, we're going to reduce income taxes by X. Or, some sort of formula, or just what he plans on doing. And he's already talked about that.
Yeah, but big problem with that, though, Mike, is that these tariffs he was able to do with executive order, which means he can just sign a piece of paper and these tariffs take effect. Tax cuts take congressional action, and he doesn't really have the support potentially for an aggressive tax cut policy. And now, the real risk he runs right now is the midterm elections coming up, that, if this market is down substantially over the course of the next 12, 18 months, he runs a real risk of losing control of the House and or the Senate in midterm elections. So tax cuts, he may get an extension of 2017 tax cuts, which doesn't change anything. Getting new tax cuts may be a much bigger challenge for him.
I don't disagree at all, but I think he's going to be talking about that.
Yeah.
And that, again, we're talking about narratives at this point. And every tweet, or I guess he does it on social, whatever, his website, but every tweet of his is going to move markets. So, this is an extremely difficult market. We're just basically going on narratives and tweets and, some news. But I think we're in for a period of just a lot of volatility. I think that's what the VIX is telling us.
Yeah, no, don't disagree. Like I said, going back to the VIX, I do find it surprising it's not up a whole lot more today, which, from kind of a bullish view, that may be good news, that, we're not seeing panicking in the volatility index, which may mean that, this morning's open the day doesn't end as bad as it starts, shall we say. We'll kind of see how this plays out today. But again, that's we're just going to have to navigate this carefully over the next few days. Importantly, like Mike said, is not to let emotional biases step in here, and don't make big panic decisions with your portfolio today. This is we've talked about this before, kind of on days like this, the best thing to do is go play golf or something. Just turn it off, go away, go do something else, because potentially any move you make today turns out to be the wrong move. You come in and you sell a bunch of stuff early this morning, the market rallies this afternoon. We've seen that happen numerous times. Even during the pandemic crisis, we saw markets sell off sharply, then rally very sharply. We'd be down 2,000 points one day. Next morning, we'd be up 1,500 points, and then we'd be down the next day. So, be careful allowing emotions to overtake. Step back, evaluate your portfolio, look at where you are, look at your performance relative to the markets, look at where your risk is, and then just start making small adjustments as you need to. But I would give the market today to sort itself out. Come back tomorrow, and we'll talk about it tomorrow morning on the next edition of The Real Investment Show. Have a great day.